So welcome to today's talk. I'm super happy to present basically one of the three papers, but also the idea around my dissertation. Let me first say thanks to everybody who helped me along with ideas through the years and with understanding a lot of these topics, discussing these topics. Special thanks to Christian and Sergey, who helped me a lot to evolve this thinking in the last years, and also to Ushi, Natalie, Martina, and Connie, who helped me to protect this data, which the ECB protects very, very carefully, the data that I used and that I extended in my dissertation. So today I will be talking about one of the three papers of my dissertation. My dissertation revolves around the topic, how does household heterogeneity affect macroeconomic policies? So my dissertation consists of three papers, and they revolve around a very simple and maybe trivial idea that households are different. For a very long time, we maybe neglected or didn't pay enough attention to this idea, but this dissertation revolves around understanding how household inequality and macroeconomic dynamics affect each other. As you know, in recent years, a lot of the macroeconomic and policy debate is revolved around inequality, but a lot of it was mostly on how do macroeconomic policies or monetary and fiscal policy or structural policies affect inequality. So this dissertation goes in the other direction. How do differences between households, so inequality, affect monetary policy and fiscal policy beyond what we have in our baseline representative agent model? So the dissertation revolves around three papers extending the ECB Household Finance and Consumption Survey to answer questions about this relationship between inequality and macro policies. So the first paper is together with Pirmin Fesla and Niki Albacete from the ONB, and basically describes and empirically observes MPC heterogeneity, how households have different marginal capacities to consume, and what are the consequences in a very baseline scenario for fiscal policy mostly. The second paper is about how household earnings are are affected differently by GDP growth, so how income and household earnings in times of maybe a boom, maybe a recession of different households are affected heterogeneously. And then the third paper, on which I'm going to talk about today, is how does household heterogeneity affect the transmission mechanism of monetary policy. So it's revolving around the idea of monetary policy and the redistribution channel in the euro area. So all these topics are relatively old. Going back even to Keynes, we can see this quote in the general theory that the amount that the community spends on consumption obviously depends on the principles on which income is divided between the individuals composing it, which may suffer modification as output is increased. So as the economy evolves in terms of GDP growth, there are distributional implications. For a very long time, maybe we neglected some of them because we didn't have enough data to quantify these channels. This is what we're trying to do in this literature. I hope I'm contributing to these kinds of literature, first on documenting the heterogeneity of marginal propensities to consume, so how different households, their consumption response to different shocks is different. Then on household balance sheet compositions, so how the balance sheets of households are different. We document this using the ECB HFCS. What does that imply for aggregate demand in an incomplete market setup? So when we go beyond the representative agent model, when you have incomplete markets, different shocks will have different implications for aggregate demand in comparison to rank, the representative agent New Keynesian model. This contributes to the literature on Hang, and mostly this main paper that I'm talking about today contributes to this growing literature on how monetary policy transmission is affected by the fact that households are different. And mostly building on the work by Adrian Auclair, his job market paper published in the American Economic Review in 2019 answers the same question for the US, and I'm answering the question on the monetary policy transmission mechanism, how it's changed when households are different for the euro area, and I'm the first to do so. So Starting from the question, how does household heterogeneity change the monetary policy transmission? To answer this, I amend the ECB Household Finance and Consumption Survey. I extend it in a number of avenues to be able to quantify this. And the main result that we will get, and I will show you, is that implicit redistribution, which happens after an interest rate change, when households are different, increases the total consumption response to an interest rate change by between 15 and 37%. So in representative agent models, we are missing this part of the total consumption response because we are missing this implicit redistribution between households. So how does that work? First, I will explain the theory behind it. Most of it was developed by Auclair. I'm just extending it in some very small ways, but let me present the baseline theory without going into the derivations. In representative agent models, the consumption of everybody responds the same because everybody is the same. The consumption of everybody to a monetary policy change is given by this equation, which tells us, when we start by the second part, there is an intertemporal substitution channel, the direct channel. The fact that the interest rate changes your decision how much to save and how much to consume. This is the classical channel, which basically dominates the representative agent model. In the representative agent Keynesian model, everything that happens to consumption, 95% of the total consumption response comes from this channel, from the fact that when interest rates change, you change your decision how much to save and how much to spend. And then there is a small in magnitude channel, that is the aggregate income channel. And in the indirect channel, again in the representative agent model, it is basically 5%, because NPCs are assumed to be very low and you're only consuming your annuity. So when there is a shock, the change in your income, you only marginally adjust how much you consume and how much you save because you are optimizing over your lifetime. Now, Auclair shows that when households are different, there are three additional redistribution channels. First one, the earnings heterogeneity channel, the fact that households are different along the income distribution. Then the net nominal asset positions channel, which is a Fisher channel. You can think about it as households are different across their net wealth. And then third, an unhedged interest rate channel, which is the most interesting one. I'll go more deeper into it, but very, very briefly explained, this is the part that is your net savings requirement in each period. What does that mean? In each period, when there is a change in the interest rate, only some part of your assets and liabilities are going to be affected. Only those that are either getting refinanced or which are under adjustable rates. Those that are fixed, let's say a deposit fixed for 10 years, doesn't change anything for you when the central bank changes its interest rate. And vice versa, mortgage with a fixed rate for the next 30 years, the change in interest rate policy by the central bank doesn't change at all your household balance position in terms of more wealth or less wealth. Only this part, which is unhedged, which gets refinanced, is what affects your aggregate wealth. So the theory, or how we approach this question, is starting from a simple single consumer problem. So a lifetime savings consumption savings problem. Imagine there is a single household with arbitrary preferences, perfect foresight. They get some unearned income, so endowment or dividend, and some real wage. They can save in real or nominal assets. There is a price level in this economy, and there is a price of zero coupon bond. So the problem for this simple single agent can be written like this. They maximize their utility given their budget constraint. And their flow period budget constraint can be rewritten using the terminal condition to show that basically in their lifetime, the sum of their consumption will be equal to the sum of their human wealth, so all of their income, either endowment or earned income through wages, and their financial wealth. So at the end of their life cycle, they cannot leave any bequest. So everything that you consume will be the sum of your earned income or unearned income and your financial wealth, which is basically your bonds. What happens after a monetary policy change? The easiest way to show this, Gali chapter 3, classical way to think about this, is with this graph. So an interest rate decrease leads to an increase in the price level, so inflation, and to a change in aggregate GDP, aggregate income. Okay, so interest rate goes down, inflation goes up, and the price level goes up, which is GDP, and aggregate GDP goes up. Using one of the, I would say, rather famous papers by 7 advanced central banks, advanced economy central banks, I will use these as baseline estimates of the effects on the aggregates from this interest rate change. So 1% interest rate decrease leads to 0.2% inflation, so additional inflation of 0.2%, and GDP growth of 0.4%. This will be my baseline number. So 1% decrease in the interest rate, 0.2% increase in the price level, 0.2% in increase in income. How does the single household that we saw before that, how does their household balance sheet get affected by this? What are their exposures to these changes in the macro environment? First exposure, very clear. Aggregate GDP increases, aggregate income increases, their income increases. So individual income is affected. Individual net wealth, nominal wealth will be, well, nominal wealth will not be affected, but real wealth will be affected because of the increase in prices. So your nominal wealth will now erode, but if you are indebted, your nominal net position is negative, you actually get a wealth increase by the increase in prices. So this is the second chart. And then the third one is the one that I said already, a bit more complicated, going beyond what we normally think about, so-called unhedged interest rate exposure channel, which is the difference between your maturing assets and maturing liabilities. If all your assets today are fixed for the next 10 years with a fixed interest rate, and all your liabilities in the next 10 years are fixed with a fixed interest rate, the interest rate change doesn't affect you at all. It is only these parts that will get refinanced. If you have to refinance your mortgage today, or if you have an adjustable rate mortgage, or if your deposit gets readjusted with interest rates, you will have a wealth effect by the change in the interest rate. So given all of this, we can show that the single household that we talked about, their consumption is a single household consumer problem. Now will be given, their consumption response will be given by the second part, which is the normal, classical, intertemporal substitution part. And the first part, which is the sum of products between your exposure as a household and the changes in aggregates. And then multiply the marginal propensity to consume, because this is how much, given that something changes for you in the aggregate environment in the economy, in your own balance sheet positions, and you react to this, given some marginal propensity to consume, this will be the effect on single household consumption. Now, going beyond that, let me show you. These three positions, so basically you can think about this here as your income, let's say that it's normalized, so it's 1. Your unhedged rate exposure, so how much your net savings requirement is, maybe positive, maybe negative, and how much is your net nominal position, so nominal. When we look in the data, you will see that households are very different across the dimensions. First dimension, it's pretty clear. We know that there is income inequality. This graph shows you 5th percentile, the 50th percentile, the median, and the 95th percentile of the income distribution, normalized to average consumption. Okay, so there are differences in the income level. This is pretty clear. When we look at net nominal wealth, there are not only differences, they go in the opposite directions. So the representative agent model will tell us something like this. This is the median net nominal wealth in the economy. This is a household that basically may have a very high mortgage, but a lot of assets, so they are pretty much at zero net nominal wealth. However, at the lower end of the distribution of net nominal wealth, you are extremely indebted. And at the high end of the net nominal distribution wealth, you have a lot of net wealth. The price level change will have effects in the opposite directions for these two households. These win, these lose. They lose from their net wealth. These win because now their mortgage through inflation gets smaller. And same for the interest rate exposure. So the lowest, so the 5th percentile, let's say, in the distribution of the interest rate exposure, these are household. So this is a household that basically pays a huge amount, and this huge amount will now get even, now with the decrease in the interest rate, they will win, because now they will have to pay less interest rate. And vice versa, those that receive, now they will receive less from the interest rate payments. So these are their unhedged interest rate exposure, and right in this period, when there is this decrease in the interest rate, they start losing. We can even quantify this in the data. So this is the euro area data. I will talk about it in a second, but just the effect on individual households from this monetary policy experiment, we can quantify. Basically, we can say, in terms of income, the change for the 5th percentile, they win 30 euros by the lower interest rates. 95th percentile, they win 550 euros from this. All of them, they win. So across the income distribution, all households win in different magnitudes. Because the other two distributions, however, you can see that there will be winners and there will be losers. The idea behind this approach is when these winners and losers have different MPCs, when their consumption response is different, then it doesn't cancel out as in the representative agent model. Then heterogeneity matters. And now the idea is that we will show that they indeed have different MPCs. They indeed respond differently, and the fact that there are winners and losers means that there is implicit redistribution from interest rate changes, and the total consumption response is amended. How do we get to this? Well, basically, going from the single household, we can aggregate this economy under certain assumptions, a closed economy with many agents, assets and liabilities net out, so there is no outside world. Somebody has a lot of assets, other has a lot of liabilities, they cancel out. And we can show, and also we can introduce income risk, incomplete markets. Basically what Auclair shows is that the total consumption response in this economy can be given via sufficient statistics, meaning that you only would need data to be able to evaluate how much is the total consumption response in this economy. And this data revolves around 5 channels. So 2 of them are our classical channels. So basically the aggregate income channel, which we already discussed in the beginning, the substitution channel, also discussed at the beginning, and the 3 additional channels, which will be described with covariances between what is your exposure, for example, in terms of the earnings heterogeneity channel, where are you in the income distribution, what is your MPC? The covariance between these 2 elements will give us this part of the redistribution channel. Then the same, where are you in the net nominal position of households? What is your MPC? The covariance between those 2 will enable us to quantify this part of the distribution channel. Then finally, where are you in the distribution of these unhedged interest rate exposures? How much is your MPC? We'll be able to evaluate this covariance. These covariances in the representative agent case, they're all 0. And that means that basically when they are all 0, we return to what we showed at the beginning. But when households are different, the total consumption response is amended by these 3, can be described with these 3 sufficient statistics, which enable us to evaluate these channels. So now my goal is to evaluate them. What I will do, okay, they can also be translated, by the way, these covariances can be transformed into elasticities. It makes it a bit even easier to understand them. Basically, the previous equation can be shown also in that form here. And basically here, which means we need 5 estimable, we have 5 estimable moments. If I have the data on the distribution of households and their MPCs, I'll be able to estimate this. And I need to do only 2 assumptions around those 2 objects, basically sigma. Okay. So sigma and gamma. So sigma is the classical intertemporal elasticity of substitution, very classical object in macro. We'll assume it's 0.5, as many macro studies do. And then gamma will be the single household earnings response to aggregate income earnings change or income change. What does that mean? We'll assume here it's 1-to-1, meaning that when the economy grows by 1%, all households also grow by 1%. I will relax this assumption. This is the second paper. I will just briefly show it, but for now, I'll keep this assumption. All households, when the economy grows by 1%, also their income grows by 1%.
The residual substitution is the same for everyone too.
Yeah.
So utility functions are identical.
Yeah.
That could be a question too, no?
For sure. For a long time, a lot of the literature that tried to do household heterogeneity actually went through these different utilities, different preferences, different ways to show that people have different patience. We don't do this here. Okay, so now going to the data. How am I going to evaluate this? So I take the ECB HFCS, which is a very detailed household survey that's been done in the euro area since 2010. Now we have 4 waves of it, and it enables me to basically get almost all the data that I need. I extend it in some important ways. First, because the HFCS gives me data about household consumption, but only part of it, so only non-durable consumption. So I basically scale up to obtain total consumption of households by taking the different shares that different households have in terms of services and durable. So, for example, richer households, they consume more durable consumption, whereas poorer households, a bigger share of their consumption is non-durable consumption. So just scaling all of the households upwards, that doesn't work. That would give us a biased result. So I scale up consumption to get total consumption. I can basically, with the data I have, I can calculate this unhedged interest rate exposure, which is basically the difference in it, the refinancing needs that you have in each period. So this non-guaranteed part of your interest rates, which after the interest rate change will also change, your payments will change. I can easily obtain the net nominal assets because I have all kind of assets, no kind of liabilities that households have. Income is only pre-tax income. I compute after-tax income. And then the crucial part is the MPC question. So since 2017, the HFCS includes an MPC question asking households, imagine you unexpectedly receive money from a lottery equal to the amount of income your household receives in a month. What percent would you spend over the next 12 months on goods and services, as opposed to any amount you would save for later or use to repay loans? This is one. There are 3 approaches now in the macro literature of obtaining MPCs: natural experiments, structural time series, would say spend will not spend anything out of this extra income. A lot of them are some rule of thumb households which say we'll spend just half of it, and then there are others which are at 1, which basically relates to some of the macro models that we used, where we were saying there is a lot of Keynesian households, there is a lot of Ricardian households, and there are a lot of households in the middle. But recent research by Stephanie Stancheva shows that actually these results also come close to what you would get from natural experiments. When you do tax rebates or other natural experiments and you calculate ex post how much is the MPC of households, that the distribution looks like this. So I believe that this is something we can use and is useful for our analysis. Our analysis now revolves around asking this question. What are these 3 objects? How do they look? The covariance between what is the MPC of households and what is their position in the unhedged interest rate distribution? What is the covariance between their MPC and the net nominal position, so their net nominal wealth? And what is the covariance between the MPC and their income level? If all 3 of those are negative, that means that will boost total consumption response in comparison to the representative agent model. Right? I told you that if all 3 are 0, we are back to representative agent model. And if all 3 are negative, that means that in the representative agent model, we're missing some elements. And now I'll show you results, basically starting from Italy, showing that all 3 of these covariances, so this is just graphical, but we calculated them as covariances, are negative relationships. So in terms of income, poorer households have higher MPCs. In terms of unhedged interest rate exposure, poorer households have higher MPCs. In terms of net nominal position, poorer households also have higher MPCs. This is basically the distribution we have. Let's say for Italy, we have 3,720 households. These are 100 bins. So I report here the average of each of these 100 bins. So in each of these bins, there are 37 households. For the whole euro area, I have around 42,000 households. So each of these bins, when I show you in a second, will be 420 households, their average MPC and their average, for example, here, net nominal position. Here, everything is normalized by average consumption so that I'm also able to show it between countries. So Italy, clear negative relationship. Going to Germany, much flatter relationship. Here you can see that we basically, for some of the exposures, we obtain the negative relationship, but for example, on income, it's relatively flat. My main goal is to estimate this at the euro area level. So in the euro area, when I get all the households, they are weighted, so they are representative of their weight in the household distribution in the given country and also in the euro area. Basically, this is how these three relationships look. All of them are negative. I'll show you in a second what that has been quantitative.
Is it one wave of HFCS or is it pooled?
So this is here the fourth wave.
Okay.
I obtained exactly the same results with the third wave. And I only have it for the third and the fourth, because before that we should have the MPC question.
Which years are certain?
2017 and 2020. Okay, so now we can quantify, we can move from these covariances that I showed you to elasticities. And basically, I can quantify how much is the extra effect on total consumption response through this implicit redistribution. And basically, the overall result is that through implicitly creating winners and losers with different MPCs, the redistribution channel, the three redistribution channels, increase aggregate consumption by 18 basis points, in addition to what we have in the representative agent model. This is very much in line with the results that Auclair gets for the US and for Italy. He also has some results for Italy. How we can think about them? In a sense, this looks small, but you should think that the substitution channel is always dependent on the intertemporal elasticity of substitution assumption. So here I took an assumption of 0.5. If it was lower, and there is a lot of discussion, some finance guys say it's lower, others say it's higher, this effect through a substitution channel will be even lower and might get close to what we have as an effect from the redistribution channels. So it's completely feasible that these two channels are almost similar in terms of their magnitude, in terms of their overall effect on total consumption. When we decompose this is how it looks in terms of total consumption response and the contribution of each of these 5 channels. As I told you, in the representative agent model, intertemporal substitution completely dominates. If I show you the same picture for the representative agent model, 95% of the effect of the total consumption change will be because of this substitution channel. Here, looking at the data, this is a merely 1/3. Aggregate demand is much, much bigger. Why? Because in the representative agent model, we assume that MPCs are very, very low. And in the data, you saw that actually they are around 0.5. Actually, the average for the euro area is 0.45. So because of this, aggregate demand becomes much more important. And here you see that overall, 13% of the response in this calibration comes from these extra channels, which we would miss in the representative agent. Actually 14%. So it's some of the 3 extra Fisher channel, earnings heterogeneity channel, and unhedged interest rate exposure channel. Now let's go beyond that. A very important assumption, and this is the other paper. 5 minutes. I can do it in 7. So a very important assumption so far was that aggregate GDP change leads to one-to-one change in individual incomes. So now I'm going to relax this. And this is something that's been discussed theoretically, for example, in Auclair, by Werning. I'm going to relax it by saying, okay, this gamma, which gives us this gamma is basically the change in individual household earnings when there is a change in GDP. Now I'm going to compute earnings changes using the HFCS panel. This is the second paper. Here I'm going to show you just the main results. So estimating the sensitivity of individual earnings to total GDP changes. In another paper, I do it with 3 different data sets and I compare them. But here I'm going to show you only the results with the HFCS. So the HFCS results, so far we assumed this should be at 1. And now you see that this is actually very, very heterogeneous. What do these results tell us? It tells us that the lowest decile, their change in income, their earnings elasticity to aggregate change is at around 3.5. So when there is 1% GDP change in the economy, on average, their income changes by 3.5%. And vice versa. For the highest earners, their earnings elasticity is below 1. So meaning that when there is a GDP change of 1%, on average, the highest decile changes their individual earnings by, let's say, 0.7. By the way, these results for Europe, these are the first results done for Europe in that sense, and they're very close to very famous results by Guven et al. For the US. Basically, they're very, very much very close to their results. So now I'm going to relax this assumption that I had before, that everybody would win, so to say, in relative terms, the same when there is an aggregate GDP change. Now I will impose these earnings elasticities, meaning that different households will have their individual earnings changed by different magnitudes given the aggregate GDP change. And now I run again the same calculation with the covariances, and now you can see that the effect of the earnings and elasticity, earnings elasticity heterogeneity becomes much bigger. So it was 0.1, now it's 0.09, so 9 times higher. It grows even further, so I do it using 2 different approaches. One is by deciles, one is by individuals. So I follow, there is a panel component in the HFCS. Across each wave, there are 50% of the households which are the same. So I can follow how their incomes change in these 3 years, and I compute what is their earnings elasticity in comparison to how much their economy, so their country GDP change in that period. So now you see that actually the earnings and elasticity heterogeneity channel increases and contributes much more to the total consumption response. Actually, in the aggregate, you can see here, we were, remember, at 14% was the contribution of these redistribution channels. Now, in the case where I take individual earnings elasticities, you can see that we reach 27%. The total consumption response to the interest rate change is 27% of it can be explained by these redistribution channels. And now the final result is basically to show this is our standard case, representative agent New Keynesian model. Interest rate decreases by 1%. How much does consumption respond? It responds by 0.75. Expanding this by first including household heterogeneity, but all the individual earnings, they react in the same magnitude, so 1 to 1. These gammas are 1. Gives us to a total consumption response of 0.86. Then we expanded with earnings elasticity by decile. So now, as I showed you, each decile responds differently to this aggregate income change. This increases the total consumption response to 0.94. And then finally, when each single household responds differently to aggregate economic changes, aggregate GDP changes, this increases even further to 1.02. This is an increase between representative agent model and household heterogeneity models of between 14% and 37%. So this is important because it enables us to explain much better and understand much better how these differences between households, their household balance sheet positions, their exposure to these interest rate changes, and macroeconomic aggregate changes affect the transmission mechanism through the transmission mechanism of monetary policy through consumption. And I believe that all of this shows that Studying differences between individuals and between households is important for understanding any macroeconomic dynamics, but in this case, especially so for monetary policy. So thank you.